So today we are going to take a look at the 7702 update and go through some information. We're going to have some fun with this one, and we've got a lot to cover. So the 7702 update really is a big change that has occurred in the life insurance industry, and it impacts whole life insurance more than anything else. The biggest impact is really the guaranteed rates on whole life insurance products. Since the 1980s, it has been at 4%. And then also the MEC limits. You will see higher MEC limits on life insurance policies than what they have been for a long time now. Now, as we get into it, from a high-level overview, here's what you will notice. If you are looking at a whole life insurance policy and it is designed for maximum cash value, so if the purpose, your goal is maximum cash value, you're putting in $100,000 per year and a policy is designed properly, you will see old product compared to the new product. The new product, based on these new changes, will have weaker guaranteed cash values. These are for individual whole life insurance policies. If you had a chance to view our BOLI product video, where we actually had the privilege to look at the old product compared to the new product, with banks it's a bit different. Banks, the new product was stronger in terms of cash value, both on a guaranteed and non-guaranteed standpoint, even though the guaranteed rate was less. So with individuals or individually owned policies, that is not the case. Guaranteed values are lesser. Non-guaranteed values and the potential earnings on a whole life insurance policy is much stronger, and we're going to look at a side-by-side comparison. MEC limits have increased, and we're going to go through some detail on that as well. The loan rates on whole life insurance policies. With most companies and products, you'll see that they will either remain the same, and then some products, they've actually kicked the rates down as well, which is nice if we are looking at the loan interest rate on a policy and thinking, it's a bit high compared to the marketplace. So they have adjusted in that respect. And then policy design, not much has changed there. In respect to the premium and PUA limits on whole life insurance policies, that's all the same. The one thing I have noticed is in respect to policy design is with those minimum premium policies. So if you're going with a 1090 split, for example, this new change actually favors a minimum premium more than it did before. That's always been the best means or best method to go with a high cash value policy, in my opinion, a 1090 split or a minimum premium, if your goal is maximum cash value, because that maximizes the short-term and long-term cash values on a guaranteed and non-guaranteed basis. Talking about actual performance as well, not just projections. With the new change, we've actually seen that enhanced across the board with a number of carriers. Let's get into this though. So what I want to touch on here is we're going to use this as the foundation. We're going to assume a case study of a 40-year-old male who wants the ability to pay in $100,000 per year. Now, of that $100K, we have a $10,000 base premium, $90,000 PUA, that's a 1090 split, and that will be the case with the old product and also the new one. Now let's look at some of the differences. First thing is first, the guaranteed rate. The old product, it's 4%, and it's been 4% since the 1980s. I was born in 1988. Before then, it was at 4%, so it's been there for a long time. The new product, depending on the insurance company and the product offered, you will see that guaranteed rate range between 2 and 3.75%. Now let's touch on something here. Is when I look at the total dividend interest rate, is if you Google search Mass Mutual in 2021, Google search Mass Mutual 2021 dividend rate, what'll pop up? 6%. That's why I put that up on the board. So if you have the old product with a guaranteed rate of 6%, I'm sorry, a guaranteed rate of 4%, what that means is that the surplus portion would be 2%. And the guaranteed rate plus the surplus gives me a total of what? 6%. Exactly what I see there on that dividend column. Now, if I have a 3% guarantee, for example, it'll be different. So I still have the same total dividend interest rate of 6%, but the difference would be that the surplus portion is larger at 3%. So it nets out to the same total dividend rate, but what it's made up of is a lesser portion is guaranteed and a greater portion is non-guaranteed. So it's more dividend sensitive, which could be good, could be bad. If things continue to remain low in the interest rate environment and dividends do not come up, it gives the insurance company the ability to go below 4%, because right now that's the contractual floor. Do I think that'll happen? No, but it is possible. The upside is I've got greater non-guaranteed potential, but we will get into that in full detail. So let's look at this piece. When I look at the death benefit here, this is important what I want to go through. Death benefit and MEC limit treatment is based on the old guaranteed rate of 4%. If I'm a 40-year-old male and I say I want to be able to pay in $100,000 per year into a high cash value life insurance policy, from a MEC limit standpoint, I would need $2.8 million to obtain a $100,000 MEC limit. That will be the case with just about any insurance company. Some companies will be 100,000, some will be 102, it's going to be 100K. Now, here's the biggest impact, is based on the new limitations, that won't be the same. And here's where it gets a little complicated, is depending on where that guaranteed rate falls, the MEC limit will be different. So for example, if I select a company or product that has a 3% guarantee as a 40-year-old male, I do not need $2.8 million in life insurance anymore. If I said, hey, I don't care about the death benefit, or that's not my primary concern, 100K per year and maximum cash value is just over $2 million in death benefit, will obtain me a $100,000 MEC limit. If the product has a 2% guarantee, what you'll find is approximately a $1.5 million death benefit is needed to obtain that same $100,000 MEC limit. So often, I will ask the question when we're working with anyone, how much do you want the ability to pay into a policy on any given year? And if someone's 40 years old and says, hey, I want to be able to pay up to 100 grand per year, we design the policy within the proper limits. The insurance company limits, 1090 split, minimum base premium, and then the IRS limits, that MEC limit. Now the difference will be, because different companies have different guaranteed rates, where for so long now, everyone's had a 4% guarantee, which has a direct impact on the MEC limit. So it was easy. All companies would have approximately the same MEC limit. Not the case anymore. Now we're going to have to be well versed with different companies, different guaranteed rates, and as they change. So that'll be fun. But hopefully this provides some clarity as far as the changes there. In fact, let's look at an illustration here. The main message is that the higher the guaranteed rate is, the lower the MEC limit will be. Interesting to look at that. And if you do things right, you will see a difference, but it shouldn't be too much of a difference on the net guaranteed cash values. And in future videos and case studies, we'll go through that. If you're working with us already, we can provide that information. So let's take a look at this demonstration right here. So let's first look at an old product based off the guaranteed rate of 4%, which is exactly what this guy is. What I want to highlight here, touch on, far right, total death benefit just south of $2.8 million. So this is for a 40-year-old male based on the old product with a guaranteed rate of 4%. So the question is, from a MEC limit standpoint, where's the number? Because I can tell you it's $100,000, but if you have not seen any of our videos, you're like, you're some dude just telling me it's a 4% guarantee and a 100K MEC limit, because it is. People tend to believe what they can see, not always what they can hear. 100K MEC limit, 101 to be exact, age 40 male, and again, this is based on the old product. I can actually tell from the date that it was run. I ran this one recently because we can run both, but this is based on the old product. 4% guarantee, $100,000 MEC limit. Now, let's look at an example with a 3% guarantee. Different company here, because this company has not released their products that have a 3% guarantee yet. But main thing, age 40 male, guarantee of 4, 100K mech limit. Next option. Had to take a screenshot of this one because they do not lay out their mech limit on the actual PDF, on their illustration. So here's the death benefit, just north of $2 million, $2,050,000. Age 40 male. This guy right here. So we've got the red line already, just north of a $100,000 mech limit. So this is with a 3% guaranteed rate, meaning if this 40-year-old male starts in 2021, which we're in right now, and says, I want to lock in the 4% guarantee, he would need that $2.8 million in life insurance. But if he saw this product or started in 2022, he'd only need just north of $2 million in total life insurance with a 3% guaranteed product. Now, let's take a look at a 2% guarantee. So here we go, 1090 split, cash value, just about 90K. But here's really what I want to touch on. Death benefit, just north of 1.5 million. Mech limit, age 40 male, based on the new product, with a 2% guarantee, $106,000. So it'd actually be closer to 1.4 to 1.45 million, but I think you get the sense of where I'm going with this. So again, 40-year-old male, age 40 male. We looked at two different companies there based on the mech limits, but the big difference and why we see these death benefits vary along with that mech limit is because of the guaranteed rate. It is true that the mech limit has a direct relationship to my age and total amount of life insurance, my death benefit. But when you start messing around with the guarantees and have different rates there, that's where I'll see different limits with different products. So having that awareness as a consumer, but especially as an agent, so important. This way we don't say something that's inaccurate only to find out after the fact we were wrong, then we lose credibility. Never a fun case when that happens. So back to the whiteboard here. Difference in mech limits. Again, the main message there, higher the guaranteed rate results in a lower mech limit. Now, let's touch on the different guaranteed rates. I know this is deep here, but different companies have filed their guaranteed rates among the same product, different products, all differently. I keep saying the word different, but here's what I want to touch on. A couple examples. All right, it's good to actually see some material here, all right? So guaranteed rates with 3 of the 4 major mutual companies. And I want to go through their guaranteed rates. Guardian has filed for all of their products a 3% guaranteed rate. New York Life, for all of their products, $3 guaranteed rate. Mass Mutual, you know, is not the same because I have listed out their different products here. Can we go through each one of them? Oh, I definitely do. You know I can't resist that. So their 10-pay product, 2% guarantee. Non-guaranteed values look good on that, and it can certainly deliver. They swung for the fences with that one, and they did a good job bringing it back kind of to glory, because that used to always be a strong product back in the day. Their L15, 2.5% guarantee. L65 and 20-pay product. So what that means is L65, you can pay into it for a maximum of, or up until age 65, I should rephrase that. The 20-pay, you can fund it for a maximum of 20 years. 3% guarantee. And then the Legacy 100 and High Early Cash Value product, 3.75% guaranteed rate. So it'll be interesting to see what the net internal rates of return look like, because I'll let you know, just from working with these companies for a long time now, when I look at the guaranteed rates, Guardian, at their 4% guarantee, is their guaranteed values are much stronger than Mass Mutual's guaranteed values when they both have a 4% guarantee, meaning the net internal rate of return is stronger. They have a lower insurance expense. But as they've restructured everything, and only have a 3% guarantee, and I compare that to a 375, what'll that look like? Can't go wrong with any of these companies, by the way. You've heard me say the 4 major mutual companies a gazillion times, but you cannot go wrong. But that'll be really interesting to see. Now, right now, these are available, not all products, 3 of them, which we cover in our Guardian videos, but you've got your L95, L99, and Executive Strategies Whole Life. The rest, their limited pay products, will be released the fourth quarter of 2021, and some not until early 2022. With Mass, right now, this is available, and only through one of their digital platforms, CoverPath. These guys will not become available until November of this year. So depending on when I want to start, that may or may not play a role or play a part there. But good information to be aware of, at the very least. Let's look at some numbers now, because this is all well and good, but to see the actual numbers, and these are all gross rates. Remember, anytime you see a guaranteed rate or dividend rate, is that what you are actually earning on a policy? I wish it was. No, it's not. That is a gross rate that is credited after the company's insurance expenses and mortality charges, meaning I want to look at the net internal rate of return on a product. So here's what we're going to look at here. We are going to look at an example with a 3% guarantee, and we're going to compare these two. So the 4% guarantee compared to the 3% guarantee with the same company, same product. The death benefits will vary from a MEC testing standpoint, as we touched on before, but everything's identical. And really what I want to look at here is the cash value performance and the net internal rate of return. That is what I am interested in. Now I'll state this, the 4 major mutual companies, if a policy is properly designed, we often state it should deliver between 3 and 5% on a net IRR. That's still the case from everything I've seen. From everything I've seen and really have dug into, guarantees have come down a little bit, but the non-guarantees look much better. Let's have some fun. I gotta stop talking, right? Can you just show the numbers already, Steve? The answer is yes. So let's start with the worst and then look at the better options. So when I say start with the worst, we're going to look at the guaranteed values. So here, we've got the guarantees. Old product on the left, let's circle this in red. This has a 4% guarantee. And my death benefit of $2.8 million gives me a MEC limit of how much? $100,000. That's where we came up with the $2.8 million. I'm funding $100,000 per year. 100K goes in, 88,000 right off the bat. So cash rich in that respect. Looks good. IRR, -11.25. Break even point before I move forward. Again, based on the guarantees here, I want to emphasize that point. Breaking even between years 5 and 6, you're just about there, year 5. He's paid in $500,000 and he has 2,300 south of $500,000 based on the guarantees. Very attractive. And as time passes, we see the annual IRR, average IRR keeps on going up, which is great. Let's compare this to the guaranteed values with the new product. So we see $100,000 go in. Look at your first year. Got about 84%. This guy, you had almost 89%. Where's the difference? Because I will add that the base premium on both of these examples are identical. They're both a little bit south of 10%. The base on both of them, $9,100. Term cost is actually a little bit less on the new product. So why are the net values less? Well, what this particular company did is actually increase their PUA rider charge. So when we make PUA payments, it used to be 5%. It is now 10%. So it's a 5% increase. And here's where we can see that. Look at your IRR in the first year. What's the difference between the two? It's almost a clean 5%, 5.02% in this example. Very interesting how that works. So as time passes now, when's my break even? Between years 8 and 9 compared to 5 and 6. Now I'll state this, with a 3% guarantee, that's fantastic. Strong cash value performance with the increased PUA fee, that's still a low insurance expense. But when you really examine the IRR, this guy topped out at what? About 3.34%. What's this one top out at? 2.57%. So the guaranteed rate is now 3%. Here's what gets really, really interesting. It went down by a full percentage point, 100 basis points. Did the IRR drop by 100 basis points? No, it was less. The reason why is the insurance expenses have also come down. So that does help offset the fact that the guarantees are weaker, offsets it a little bit. We don't have to expect a full 1% drop there in that respect based on the annual and the average when you look at that, but it's good to be aware of that. Time passes on. There's my average IRR. So if I go to year 30, you're about 1.86%, whereas this guy, you're at 2.73. In year 30, you've got $225,000 less based on the guaranteed values with the new product compared to the old product. That's the drawback. If you are interested in a maximum cash value policy and you're trying to compare the pros and cons, for full transparency, the guarantees are worse. If all things are equal with a contribution, your payment that is. Now let's look at the dividends, the non-guarantees. So same company here, same product, everything's apples to apples. Guarantee of 4, dividend of 5.65%. So what does that mean in respect to your dividend? 565, your surplus would be what? The difference between the guarantee of 4 and the total of 5.65%, which means it would be 1.65%. Anytime you see a life insurance illustration, this is not an illustration, it's all the values from the illustration. We just pulled everything off of the illustration and put it on Excel so we could easily compare it side by side. But anytime you see a life insurance illustration, the dividend column does not reflect the dividend rate of 5.65% or whatever the company's dividend rate is. What it reflects is the difference, the surplus, the difference between the guaranteed rate and the total dividend interest rate. In this case, 5.65%. So here's the dividends, okay? The surplus piece. There's your break-even point between years 3 and 4. That is strong. As we progress over to the right, and before we do that actually, I'm so big on the major mutuals and actual performance. We've seen this happen time and time again when policies are designed properly. I've seen it firsthand because we design products like that. Mine's designed like that, one of them that is. Here we go. New product, 7702 change. Now this dividend, we've got the same 5.65% rate here. So what's this mean? As we look at this, 3% guarantee, which means the surplus would be what? Not 1.65%, but instead would be the difference, 2.65%. So when we look at the dividend column, that's based off of a 2.65% surplus, not a 1.65%. So let's take a look at the actual values and compare and contrast now. Look at your dividend in year 2, the dividend column, I should say. 5,000 and change. What was it on the old one? 3,800, almost 3,900. You start to see the difference immediately. Now, what's the cash value difference? Year 2, there's a difference. It's about $8,000 there. Old one, 190. New one, 182. Why there's a difference is, again, the PUA fee on the new one is 10%. So the trade-off is really in the early cash values. And you can see this based on the break-even. I'm breaking even year 5, not between years 3 and 4. Now, after the funding in this example, and we did look at a lifelong pay too, that's a good analysis for a future video. After the funding, what do you see here? Big difference on the dividends. Let's take a look here, just as time passes a bit. Let's look at year 20. At the very bottom here, what do you notice? Year 20, $943,000 in cash value on the old product, 2.1 in death benefit. Annual IRR and average IRR compared to the new one. 1 million in cash value. The difference, so you don't have to calculate it, is over here in purple. This column, CV difference. So we started out for almost 10 years. The first 9 years, you had less cash value in the new product compared to the old one. And why that is 100% a result of the higher PUA fee. So yes, they lowered the death benefit cost and such for the term rider and their overall expenses, but the PUA charge went up. But that is meant to increase or enhance long-term performance. But as time passes, that enhancement, year 20, there we go. 4.71 on the IRR instead of 4.04. That's a big difference annualized, and 3.92 on the average. And you will see that thing get over 4% on the average as well. So it really cranks as time passes. And that's really the hope insurance companies have. And they know what they're doing too, which the major mutuals do. And I'm sure all companies do, but that's why I like using the major mutuals. But hopefully this did help in respect to providing some numbers, some transparency. Granted, every case is different. So if you'd ever like to see numbers, we can always show them to you. Your agent can, as a number of companies now have made this product or their new products available, at least to some degree. But I do hope that this helps. I had fun going through this, just taking our time, looking at the numbers, going through the details. Feel free to reach out anytime. If you enjoyed this, please hit the like button, subscribe for more, and I'll talk to you soon. Thanks again. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.